Hey everyone, I'm Vaughn Friday. I'm a finance nerd, but not your financial advisor. Here on this channel, we like to learn how to do money things with money stuff. And I have my good friend Ollie who wants to learn how to invest. He's heard of mutual funds before, he's heard of ETFs, he's heard of single stocks, but he doesn't know how to get started. Here, hopefully I answer all his questions. If you want more financial content like this, subscribe for more.
Hello, my name is Ali. I am 32 years old. I'm an English teacher here in Shanghai, China, and I'm on Hot Tip Investments.
Welcome, Ollie. Can I ask, what are your investment goals?
So my investment goals now have been, I guess, expedited a bit. I recently got married. Me and my fiance at the time, previous girlfriend, now wife, have been saving up quite a lot of our earnings for the past 4 years. And my goal for investing right now is to hopefully retire without having to work or down the Walmart floor, as it were, and start a portfolio and get more comfortable with investing.
Do you guys, since you're married, do you have the same joint goal or that's your personal goal?
Yeah, I think our goals are relatively the same. My personal goals might be a little bit more ambitious than hers, but overall, I think we're on the same page for it.
Now, retire, what does that mean? Because retirement means different things for many people.
So when I'm, 60, 65 years old, whatever it may be, I don't want to continue working.
Okay.
If I don't have to, I'll continue working if I want to, if I enjoy what I'm doing at the time, but I don't want to be forced to, continue on if I don't want to.
So financial independence.
Yeah.
Do you know how to calculate that number?
Yeah, there's a lot of websites on board. I think last time I did it was about a month and a half ago. I think it was, in today's money, about $4.3 million. And I'll be using Canadian currency rather than the USD.
CAD.
Correct,
Okay.
yeah.
CAD. Okay. And that is invested in mutual funds?
Correct, mostly in mutual funds, ETFs, and stuff like that.
Mutual funds and ETFs. Okay, cool. Are you invested in any of those things now?
Currently, no. I have no investments at all.
So what is your net worth, positive, negative?
Currently positive, yeah.
Do you have any debts?
Yes, but that debt will get paid off in a month.
So only one debt, and it'll be gone next month.
Correct.
Are you willing to disclose?
Yeah, student loans, obviously.
Student loans.
It was about 30. I think right now, it started off at like about 50,000. Right now, I think there's about 30,000 left of it.
In Canadian dollars?
Canadian dollars, correct, yeah.
30,000 Canadian, and then you're saying next month it will all be paid off?
Yeah.
You have enough to pay it all? Mm-hmm. Okay, and that's the only debt?
It's the only debt. No car, no house yet. And just the student loans. Credit cards are all paid off. There's no line of investment or line of credit or anything.
That's great that you're able to pay off that much in one big...
Well, again, so we've been saving up for quite a while now. Yeah. And, since the interest rate was deferred, I thought it would just be better to continue saving rather than just be like, here's money. But since they're not being deferred anymore, it is time to pay it off.
Yeah, it's imperative to pay it off. So with that 30,000, you graduated with a degree. Are you planning to go back to school again?
I'm currently in school. I'm doing a master's degree. It's cash flowed.
So no debt?
No debt.
No debt. Very cool. Now, you don't have any credit cards?
Credit cards, yes. Credit card debt, no. I pay off my credit card every month.
Okay.
A week or two before it's due, so there's no issues there.
And then how long did you not pay your student loans?
So, no, I've been continuous to pay my student loans, even through the deferment of the interest, because...
But you're going to do a big lump sum to avoid the interest. Yeah, correct. That's cool. Yeah. Now, you're not invested in anything, so after you pay the 30,000, do you still have an emergency fund left over?
Yeah, so currently... So, if I'll just go through my finances with you as well. Currently, as an emergency fund, we will have $32,000
Canadian dollars?
Correct. Then after that, I would like to start investing in things. Initially, I think I want to start off with about 10,000
in investments.
Yeah,
10K initial.
correct.
Okay.
I think that's a good place to start off with, and then again we can talk about that a little bit later on. And in the near future, I'm looking to down payment on a house.
Okay.
That's needs to be about 20 to 25% down payment.
And how much would that be?
That kind of depends on the valuation of the house. What we're looking for is somewhere around 500, closer to about 750, I think.
750.
$750,000 house. So 20 to 25% of that is whatever the math ends up being.
200.
So let's say 750,000 times 25%. But just under 200K, so 187.
187. 187K. You have that now, or you're saving up for
Correct.
that?
No, we have that now.
So you have the 32, and you have 10 to invest, and you have 187
Yeah.
for enough for a down payment for 700. All in cash?
Oh, no, well, yeah. This is not nothing. It's just in a savings.
High yield savings or just regular savings?
Well, so actually, I learned this recently as well. China doesn't offer high yield savings.
Oh, so this Canadian dollars is in
correct, exactly. So
currently
I'm
RMB.
transferring the money we have mostly in Canadian dollars to keep it all in Canadian, but it's currently sitting in RMB.
Okay, yeah, currently sitting in RMB, and then when you transfer it, you can move it into high yield savings account.
Yes, that's the plan for when we go back to Canada. So we're going back to Canada, and the plan is to get a good chunk of our finances into Canadian dollars, so then we can start taking advantage of.
Well, I think you're in a very good position to start investing. I think I don't need to help you with your behavior with money.
That's not entirely true.
That's not true. Let's dive into that a little bit.
Yeah.
Why do you say that?
Well, here's the thing. I guess previously I haven't really looked at money as a like, how can I take my money and build it? So turning money into money.
Yeah.
I usually would just spend most of my earned income to, things I like to do or whatnot. But I mean, so that behavior has changed initially, but I still go out to eat a lot and order food.
I don't see a problem with that. Like, you're spending money that you have.
No, so earn. Previously, before I had met my girlfriend at the time, now fiance, now wife, I used to just spend my entire income. Like the entire, so my month would go from, whatever income I make, and, living here in China, we make really good income as foreigners. By the end of that month, after, rent and utilities and whatever else was taken out, it used to be nothing. So I would have very little in savings, very little things, and it would just be
so how much
frivolity.
So that was before you met her.
Yeah.
You spent all your stuff, but you didn't go into debt.
Correct. Yeah. Well, at that time, I had debt.
Oh, you had debt.
Right. So I had 2 fully maxed out credit cards. I had student loans that I was, still paying on. I was still paying minimum monthly payments on those credit cards. This was 4 years ago, mind you, right? So all of that, and then I wouldn't open any lines of credit or anything like that, but it was just maxing out my credit cards, but paying them, and then paying my student loans as well. So realistically, my
girlfriend, fiance, now wife has curved that behavior so that right now I think we our needs category meets that under 50% threshold, and then literally everything else we save mostly. Is this finance a joint, or is it just yours?
It's joint.
It's joint.
Correct. Yes.
So I mean, it's still positive. You went from a negative expense and no savings to within 4 years you've built a nest egg of over multi six figures.
Yeah.
So that, I mean, I don't see that as bad at all.
Right. No, very grateful to her for curbing my spending habits and making me look at savings as not a chore to do, instead of being hey, look, we need to see this money grow, and one way to grow it is just don't touch it. So that's it.
Don't touch it.
Yeah,
that's a good one. So you're here because you want to learn how to invest. You have some questions you prepared.
Right. So again, I'm very new at investing, right? I've done quite a lot of research and things like that, but there's so much information out there that it's not overwhelming, but it's all different. People will tell you like different things, and like, you know, some people have their not priorities, but I suppose
They want to sell you
preferences. Well, I guess these are like my friends and family members and things like that. So they're not really trying to sell me things, but they have their own different preferences of
From what they learned,
exactly
experience.
correct, right? So I think right now I'm in the stage of I need to get as much information from every source possible, and then try to make the best decision I can from all that information, what suits my needs and my preferences and things like that.
No, that's true. But from what I learned about money, like you can tell people numbers as much as they want.
Yeah.
But it's based on feeling. Like they'll pick on feeling.
Well, see, here's the thing. I'm very different in that. I don't really care about the feeling part of it. Tell me the exact number, and that's the choice I'll make 99% of the time.
So what are your questions then?
So my current questions is that how do I start investing? Like pretty much right off the go, like, so for what I know is that there's multiple ways of doing it.
Yes.
Number one is that either you have to start a
Brokerage account?
so that and you can do that with your bank, but then you're locked into whatever accounts that your bank has access to in that sense, right? You can start things like a tax-free savings account. In Canada, it's called an RRSP, so a retirement savings fund. Or a TSFA, so tax-free savings account. Problem is, for both of those,
You need income in Canada.
Correct.
Which you don't have.
Now, there might be some RRSPs that you can do as an expatriate. TSFA is completely locked out. But the RRSP as an expatriate is also very limited. So starting a brokerage with the bank seems like the best option, but which bank do I start off with? Things like that. So currently I'm in the process of figuring out all that information. So my question is, initial question is like, how do I start? So let's say if I do have, let's say the 10K in my checking account, where do I put that 10K? And to even just be like, okay, here, now I can start in the stock market.
Let me make it a little bit easier for you. 10K is a lot of money. Let's start with $100.
Okay,
100
cool.
Canadian dollars. Okay?
Yeah, you got it.
You can open a brokerage account without a bank. Since you're in Canada, there are two that I recommend. There's Vanguard, VANGUARD. They can invest your money in the Toronto Stock Exchange and also the New York Stock Exchange, convert it. Also, Charles Schwab. But I recommend mostly to do it all in USD because there are Forex fees transferring Canadian to USD whenever you purchase a
Through
trade.
Charles Schwab.
Yeah.
Okay.
Things like that.
Vanguard will do it through the New York Stock Exchange.
Yeah, both of them do it through the New York Stock Exchange.
Okay.
And they also have...
Vanguard doesn't charge you fees for trading in Canadian dollars.
They do.
Okay.
Yeah, they do. They both charge. Well, so if you buy something Canadian using Canadian dollars, there's no fees.
Correct.
But if you buy something US
Yes.
with Canadian dollars, there's a fee.
Yeah.
For both of them.
Now, I've also heard that you can buy like ETFs.
Yes.
Which I'm not exactly sure what that stands for.
Exchange Traded Fund.
That's it. And they have stocks from like using, let's say, for example, Vanguard. You then purchase an ETF. And that would have like stocks from the American market on it as well, correct?
Yeah, there are funds that have both stocks from Canada and stocks from America.
Okay.
Yeah. So you want to know about the fee structure, about ETF versus like mutual funds?
Well, so let's back up a second here, right? So let's say if I put $100, let's say I start an account with Vanguard, right? And let's say I put $100, right, into the Vanguard account, I suppose. Is that how it works? Yes. And then let's say I want to buy stock A, right? Let's say if I put $100 into stock A, now you would want to diversify, blah, blah, blah. We'll get later on that line. But let's say if you put $100 into the stock, then the fees kick in, correct?
So if you buy a stock, usually there's no fee.
Okay.
With these two, if you do it with your bank or other things
Right.
like
Because the bank currently that I'm looking, well, my current bank, which I'm probably going to change because they're charging me $16 a freaking month in fees for no reason, is we're going to change that bank account to not have fees anymore. And then
$16. That's all it takes for him to be pissed off and change his bank account, which is why you should do that too. I got pissed off over $6. Chase charged me $6 because I had less than $5,000 in my checking. I was like, F this. I'm moving all my money to my brokerage account. Bye-bye, Chase.
literally. So like I started this bank when I was, what was it? Oh man, when I was 15, 16 years old, right?
Yeah.
And they're like,
Grandfathered in, parents.
Right, exactly. Parents are using the same bank, no problem. You don't have any fees. You're a college, like you're a student, no worries. And then when I got out of college, I had student loans. So they're like, oh man, don't worry about it. You have student loans. We're not going to charge you fees, da 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 da. And then we'll talk about that later. So my student loans got taken out of my bank account and put into the government holding or whatever it is. And then they started charging me fees like 2 years ago. Now, since I live here, I don't really use my bank there. I just have, like $6,000, $7,000 sitting in that account. I never really check it. And no money goes in, no money really goes out. And then 2 years later, I look and I was like, there should be more money in this account. And then I looked at the transaction list and I was like, they're taking away $16
every month.
Every single month. Now, like my payments for my student loans and credit cards go through that account as well. So like money does get taken out, or I can put it back in. So the $16 kind of got lost in that payment. And then, so I was just, then I looked at it, I was like, what the Christ is this? So,
don't use those banks. There are services that do it for free and a better job.
There are.
Yeah.
TD Bank, 0 fees if you have
TD Ameritrade?
Sorry?
Is it TD Ameritrade or just TD Bank?
TD Bank, yeah.
Oh,
so,
okay.
Yeah.
Toronto.
Direct Bank. Yeah.
Oh, Toronto Direct Bank. Oh, very cool. Now, as far as the stock goes, you buy the individual stock. You own that stock. There's no additional fees.
So no fees. Okay.
No fees. But an ETF, so that stock means that you are personally managing it under your own brokerage account. So when you open a Vanguard or Charles Schwab, you will open an investment brokerage account or a cash management account. Those are the two.
What's the difference?
The main difference is the cash management gives you a debit card, so you can withdraw from it. Versus the investment is like, nope, only investments.
What would you suggest?
I have two. So I always transfer to my cash management, and then when I feel like investing, I buy the investments and I move those investments to my investment brokerage. Yeah.
Okay, so you're using it through the same bank?
The same brokerage. So I personally do not have a bank. I just have a brokerage. So my cash management account gives me not as high as a high yield savings, but it just so a high yield savings right now is above 4%. Mine.
Where? Because I'm not able to find any high yield savings investments that do under like more than 2 as Canadian banks.
Canadian banks? Well, that's why you probably should use American stuff. Yeah. Probably switch it to USD, and you could use Charles Schwab and Vanguard. They probably have high yields in their cash management above.
Yeah, I'll take a look at that because I don't really need to touch the money, but
because
American dollar is kind of tanking right now, though.
Yeah, could be. It's getting stronger.
Is it?
Yeah, it's getting stronger.
Canadian exchange rate used to be like 8.4, 8.5. I think it's like 9.4, 9.5 now.
Yeah.
So
Canadian dollar could be.
yeah, that's something that I don't know enough about.
Yeah. But just in holding the businesses, I prefer doing everything in USD. Of course, I do hold like foreign stocks. Like I have one Canadian stock. I have like 2 French stocks and 2 Chinese stocks.
Sure.
But I buy them all in USD.
Okay.
I'm not telling you to buy individual stocks. I would rather, since you're wanting to dive in this, just put your toes in with an ETF.
Okay.
So an ETF, there are 3 types of fees.
Yeah.
The first fee is called a load. So there are 3 types of loads: upfront load, back-end load, and no load. So these fees are with mutual funds as well.
Okay.
So a load usually upfront load, you pay upfront before your money is invested. So if you have $100, the average fee is around 5.75%.
Okay.
So the money you actually invest with that $100 Canadian is $94.25. But the reason why people do that is because one of the other fees is lower because you pay that upfront cost. The other one is the back end load, where you pay the fee when you take the money out. So you pay nothing going in, but as it grows, and then when you pull it out, then you pay the 5.75%, which is a lot worse because it's a big chunk. It's bigger chunk because assuming that your investment grows. Yeah,
correct. So you would recommend paying the upfront fee rather than the back end fee because the back end fee is when you withdraw rather than you.
No, I prefer paying no load. But, I'm just letting you know because people will try to sell you on buying these funds and they'll show you. So right now, I just explained just those two those two loads, and you're like, oh, I want to do the upfront one. Right? And then there's no load where you don't pay either way. Then you're going to ask, why doesn't everyone just do no load? Right? Why does everyone? Because of the second fee, which is called the expense ratio.
Okay. And this is only the expense ratios.
So every fund has one of these loads, and every fund also has an expense ratio.
Okay.
That is the fee of managing that portfolio.
I see.
So the fee for a no load fund is usually higher than a fee with a load. So if you imagine losing percentage points every year, you lose a higher percentage points with no load, but you'll pay less if you put a load.
Through management of portfolio.
So like on average, if you have a loaded fund, you would pay around like 0.8%.
Yeah, for the expense.
For the expense. So every $1 million, you're paying around $8,000.
So 0.08.
Yeah. No, 0.8.
0.8 would be 80%.
No, 0.8%.
Oh, I see. 0.8%. Yeah, okay.
0.8. You're not going to pay 80% of your investments when they can't even get 10.
Right.
Yeah, 0.8%. And then if you go no load, they'd probably add a percentage on that. So it would be 1.8%.
Okay.
So
you think the 1.8% of your, of what is this? Of your
entire portfolio. So not just profit. It's all of it. Now,
does that then yield more than paying the upfront?
No, I'm just letting you know the fees and how to avoid all of this. And
sure. Oh, okay.
Because they're going to try to sell you this, and I'm trying to let you know what everything means.
Sure, yeah.
That way you're like, no, I don't want to buy that product from you, banker. Yeah. No, I can do it myself.
Okay, sure.
I'm Ali.
Yeah.
And then the third fee is a hidden fee. It's called turnover rate.
Turnover.
Well, there's a fourth fee, taxes, but we'll go over that. That's when you take it out. Turnover rate. So turnover rate is the fee that's hidden. It's the manager buying and selling. There's a fee whenever they buy and sell because they're buying in such huge volumes. And the losses sometimes they make over the trade that will cost you, but it's a hidden fee. It's not applicable to the 1.8%. So it's 1.8% plus
a turnover fee.
Turnover fee. So turnover. So on average, from what I was told when I first started, a low turnover rate is 20%. So if you had a basket of 100 stocks, that mutual fund manager would sell 20 and buy 20 every year.
Okay.
That's pretty. And then there was another fund he was trying to sell me 67% turnover rate. That means 67 of the companies he would sell and buy 67 new ones, the average every year. Now, what I'm going to tell you is Vanguard and Charles Schwab offer ETF index funds that track the S&P 500.
Right.
Now, the S&P 500 is the top 500 profitable U.S. stocks.
Yeah.
Okay. Now, these have the same fees, but we're going to go over their their fee breakdown.
Okay.
So with their load, do you think they have a upfront load, a back-end load, or a no load?
So I'm assuming no load.
They have a no load.
Yeah.
Now expense ratio.
So this is Vanguard, yeah?
Yeah, and Charles Schwab. If you open it like through Wealthsimple or Wealthfront or all the other apps, they have ETFs available.
Yeah.
But if you are a Vanguard's customer, they have their own version of that ETF. And they can give you a lower fee.
Okay.
And Charles Schwab also has their own, which will give you a lower fee.
Okay.
Versus the other ones, they don't have their own. They just buy what's available.
Right.
Yeah. So expense ratio if you saw 1.8 is pretty high, and then 0.8 is pretty high, what do you think Vanguard's is? Or Charles
Probably lower than that. Probably 5 or 4 or something like that.
0.5, 0.4? That's really high for them because it's 0.02%.
0.02%.
So every $1 million you have invested, the management fee is $200 versus $18,000.
Right.
Yeah. Now, their average return over the lifespan of 90 plus years is 10% annually. Doesn't mean you'll
Every
make
year it'll be at 10%, but over the average
Yeah.
of 90 years it'll be 10%.
the last 10 years, it's been above average at 14%. Yeah.
Okay.
And that's not including dividends and stuff.
Sure.
Yeah. So that, and then the turnover rate. Guess what the turnover rate for that is? So
Assuming
mutual-
it's less than that as well. I didn't actually know the turnover rate for like
so
the normal-
low, what I was told from mutual fund managers when they managed my funds when I first started was 20% was low. Anything lower than 20% was considered low to them.
Yeah. I'm assuming 5%.
3%.
Okay.
It's even lower.
So
Yeah.
3% turnover.
So 500 companies, 3% is 15 companies.
Yeah.
15 companies leave, 15 companies come in.
What,
On
so
average.
what does that mean?
So-
So let's say like every year they have a list of 500 companies. Every year they change 15 companies.
On average. It doesn't mean they will change. So usually a company will fall off the mark and then their market cap, if you were to buy all the stocks at that current price, that's the market cap.
Okay.
So they would be below the threshold and there's a new company that broke the threshold and now is going to replace them.
Okay, fair enough.
Or there's a company that has had a large market cap for a very long time. They just haven't been profitable.
Right.
Because you need to have a full year of profitability in a row in order to get on the list.
Okay.
Because there are large companies, bigger than like the airline companies, that are not profitable. Think like Uber, Lyft, or other brokerages like Robinhood or Coinbase for cryptocurrency. They're very, very large companies.
Right.
But they're not in the S&P 500, even
They're
though
not profitable
they're not
companies.
profitable
Correct.
companies.
Okay.
Yeah. Versus like say American Airlines.
Yeah.
Right. It was profitable for decades, but the last 3 years not profitable because of the situations. COVID and everything. But it's still on the list because nothing surpassed it.
Okay.
In that
Yeah.
area.
fair
Yeah.
enough. Okay.
It doesn't get kicked out automatically just because you have 1/4 of loss.
Right.
If you have the requirement to enter, you can stay there as long as no one replaces you. Yeah. So an example would be Under Armour. Under Armour was in the S&P 500 for a while, and recently.
But
got off
I'm
the-
assuming through these like index funds,
Yes,
right?
index funds,
You personally don't say that, hey, in my basket, I want Under Armour or
No.
airlines. It's their basket
Yeah.
that you are investing
Yeah.
into their basket, and then they decide which companies are there or not. Okay,
Yeah.
fantastic. So you're
Yeah,
just like,
you-
cool, I want to put, let's say, $100 into this basket.
Yeah.
And then whatever
And
that
that's-
$100 accrues goes back into it, correct?
And that is your fee.
0.2% with Vanguard or Trishaw.
0.02.
0.02 and then 3% turnover rate.
Yeah.
Okay.
Versus mutual funds that you wanted.
So what is this 3% turnover? The turnover of the companies or
Yeah.
how much
How-
of your money they're taking?
The turnover rate is how many companies move in and out. The fee itself is like you could figure it out, but
Yeah.
it's not really like that important.
Yeah.
This is the more.
This is the
important.
fee that you're worried
That's
about.
the
Management fee
management
/ the load fee.
Yeah.
Okay.
But it's just a hidden fee that they don't tell you about.
Yeah, fair enough.
Because you're like, why is this mutual fund not making as much money? It's because they're buying and selling at crappy times.
Okay, fair enough.
Versus the index fund is buy and hold. Like
Okay.
and,
so
and-
index funds you would use to buy and hold.
Yeah. Well, also it's less management because all they're doing is copying a list.
Right.
Versus the
Are
managers.
you copying the list?
No,
or
no. They
So
copy the
you
list.
say, hey, Vanguard,
I
you start a
want-
brokerage account
yeah.
with Vanguard.
Yeah.
And then
I want to
or
buy the S&P 500.
create a
Yeah.
whatever cash management account with Vanguard, and then you use
You use the money here and then you buy it and then that investment is now in your cash management account
I see.
or it's in your investment brokerage
I
account.
see. Okay, cool.
Yeah. You hold
Okay.
Yeah. Yeah, so that's what I recommend to most people. I don't recommend single stocks.
Yeah,
unless
because
you
that's what I
really-
was worried about as well. Because I don't really want to manage single stocks. Yeah. Okay.
Yeah. So
But
this
managing
is-
indexes seems a little bit better.
Well-
or even ETFs.
Well, when I first started,
Yeah.
I just put in money every month without I don't even have to look at it.
Okay.
Yeah, because they're managing it for me.
Okay.
But with single stocks now, I have the same approach.
Sure.
But I'm
You keep track of this, how the single stock is doing in the market.
no.
Not really.
Not really. Like when my dad tells me to sell everything, I just buy more and then I just take a picture
Yeah.
next month of
Okay.
how much
Fair
I
enough.
made.
Fair enough.
And it's like, okay, he'll stop.
Okay.
With single stocks for most people, it's a bit risky because they're not a financial nerd like I am. So I do recommend the funds because it's less risk and it has the word people like most when investing, diversification. When S&P 500 is diverse because you're owning 500 companies instead of just one. So if you saw something like Meta, last few years it dropped 70%. Imagine you had $1 million in one stock,
Right.
and it dropped 70%.
Right.
Most people can't handle that stomach. But if you saw the stock market, it didn't drop 70%.
Right.
It actually went up when Facebook was going down because of the weight of the other companies, which made it a diversified fund. So yes, S&P 500, highly recommend for most people who don't want to manage their investments. That's something very easy to do.
Right. Now, so like for example, I guess this goes on to another question of mine is managing your risk versus your gains versus let's say like an ETF or a mutual fund versus like going straight into like the buying, as you said, the $1 million into Meta.
Yeah, so risk is just a term of ignorance. So if you don't know what you're buying, the bigger risk there is. So when you buy an individual stock, you should know what business you're buying. You're not buying a lottery ticket, you're buying an ownership of the company.
Right.
And you have to know what that company does. If you ask people usually what they invest in, if they start investing in single stocks back home, they don't know. They just think it's going to go up.
Right.
That's what they tell you. It's going to go up. It's
Right.
like, that's not the mindset you should be doing. And if you don't want to put in that research, that effort to buy the single stock, it's okay to doing funds because you will still grow. Like I had a speech the other day. I was like, how much do you think $10,000 would have grown in 40 years if you just put $10,000 at 20 years old? You didn't invest for the rest of your life. You just spent your extra cash. You didn't go into debt, but that $10,000 at 20 years old, how much would it be at 60? In the S&P 500 at 10%. But S&P, 10%, if you invested it for 40 years, would that, how much do you think you would have after 40 years?
Yeah, probably not a whole lot. Like let's say if you invested $100.
No, if you invested 10,000 at 20 years old, at 60 years old, how much would you have? 10% annual return.
And if you continued reinvesting,
No, invested.
like whatever you gained that year, so like compound interest,
Yeah.
probably quite a lot. I don't know, maybe 10,000 initial start, probably 150,000, 200,000, something like that.
It's over 600,000.
Okay, cool.
Yeah. So that's what you could expect with the S&P 500. Of course, you can make a lot more with a single stock, but
Right.
if you don't know what you're investing in,
Yeah.
it could go down to zero.
Right.
Versus the S&P 500, the chances of it going down to zero is you're betting that the American economy is going to collapse
Correct.
entirely.
Yeah. And if they're doing, let's say, for example, the 3% turnover, all the unprofitable companies at the bottom, whatever, 15 it is,
They're going to get kicked out.
and replaced with newer companies
Yeah.
so that your overall portfolio still remains relatively decent.
Yeah.
But the gains on that is going to be much less if you just put in, let's say, $1 million on versus.
Yeah. But less. It's like average. If you look at mutual fund performance and hedge fund performance, over 99% of them can't beat the index.
Okay.
So just invest in the index.
Right.
And you're like, why do people have mutual funds and hedge funds? It's
Yeah.
because they're advertised that they'll do better, but they don't.
I see. Okay. Fair
It's
enough.
just based on advertising.
Okay.
You know?
Yeah.
The average person can beat hedge fund managers and mutual fund managers by consistently investing in the index funds.
Right. So you would say go to index funds and ETFs versus doing the mutual fund side of it. Okay.
Yeah, mutual funds they collect fees. So the salesperson that is selling you the mutual fund, they collect the 5.75% on the loads.
Yeah.
So whatever load you're paying, you agreed to pay. That's what they're getting. If
Yeah.
you got the no load, their fee is that extra 1% on the expense ratio every year.
Right.
That's their fee. And the fund itself is only getting the expense ratio.
Right.
Yeah.
Okay. Fair enough.
So yeah, I would not recommend mutual funds. It's just most people, they don't know how to start investing. And then when they're introduced to it, they're introduced to mutual funds.
Right.
So it's like, this is the way I'm going to do it. And then decades down, it's like you see how much worse it is, but old habits die hard.
Right.
It's hard for you to change. Like
Right.
I could tell my family members, even though I'm half their age,
Yeah.
they could make much more money and lose less opportunity cost wise by doing it themselves. They just don't want to do it.
Right.
Yeah.
I'm assuming because again, like they don't want to be the ones doing the research into. all
Yeah,
of
but
that, right?
S&P 500, you're not.
You don't really have to
yeah,
do research.
You don't have to
into
do
it, follow
research.
a list.
Yeah.
Yeah. Fair enough.
You don't follow lists.
Somebody else
Yeah,
follows the list.
Someone else follows
yeah.
the list. Yeah.
And then you're like, I want that pile,
Yeah,
that
yeah,
bucket. Yeah,
yeah,
fair
yeah.
enough. Okay. So on that sense, like, let's go back a little bit and talk about like Vanguard versus like other things. Now, a lot of people in Canada, especially a bunch of my friends and family, have used like companies like Wealthsimple to do it. Now, you said that you wouldn't use Wealthsimple.
Yes.
Could you explain a little bit more about why?
So before Wealthsimple, Wealthfront, their Canadian finance app, they invest and they do something like Robinhood, payment for order flow. So they're funded by a large hedge fund, and they get the trades and they process the trades for Wealthfront.
Okay.
And then they make money off you. And then that's why you kind of see these no trade fees. Whenever your friends, they buy something, they start off with a negative percent on their investment because that's the fee. They don't see that. So let's say I buy $100 stock and it's like, why is it $99.80?
Okay.
Like I bought 100.
Yeah.
They collect that. It's written on there, but
Yeah.
there's no commission fee.
Okay.
So it's like before when I started investing, my commissions like every time I traded was $10 or $15.
So then basically how they make money is
percentage, and
they
then
take a percentage of what you invested or your stock.
well, also no, not that, but when you're buying or selling something versus Vanguard and Charles Schwab, they'll try to get you the fairest price.
Okay.
Versus something like Wealthfront, they will mark it up and sell it at the higher price and keep the profit.
Okay.
Yeah. So that they make it on arbitrage. And something on Wealthsimple, these fees is if you were to invest in US companies, they're going to convert things for you. And that conversion is 1.5% every time. So imagine you're buying a stock or an ETF using Wealthsimple, you're going to pay 1.5%, which is like that expense ratio every single time you buy. And why do that when Vanguard and Charles Schwab will do it
Cheaper.
for free?
Okay.
Or I don't know about the foreign exchange, but you can buy their ETFs for basically.
So basically, Wealthsimple and Vanguard are basically two platforms that you then start an account with, input money, and then trade off their account portfolio, correct? Yeah.
And Vanguard has
and then you just want to look at the fees and structure of how much of your investment that they're actually
because
taking away.
you specifically, you're not looking at other investments other than the S&P 500. If you want to look into other things, then we can go over that and over.
Well, I
the
would
returns.
potentially not right now, but maybe in the next year or two, look into doing like single stocks and things like that. But for right now, just to like dip my toes into it, see how the platforms work, see what fees are, whatever. I don't want to invest like a big chunk of money into it.
Yeah, that's what I was saying. Like you can start off with $100 instead of your initial $10K.
Yeah, okay, fair enough.
Because some places like Charles Schwab, if you are open to international brokerage account, their barrier to entry for most people, my clients that I have, is you need at least $25,000 to invest with them. It's not that you pay them $25,000 to invest. It's like they won't service your brokerage account unless you can fund $25,000 in investments. Yeah. And just because your investments may go lower, let's say you put $25,000 and then it goes down to 15, they won't stop servicing you.
Right.
But if you were to sell that, and then they would stop servicing you.
Yeah, fair enough. Okay. So you need a minimum barrier entry.
Yeah, it's a barrier versus Vanguard. They have a Canadian version over there.
Okay, cool.
Vanguard is
so
the
look
US.
into Vanguard is what you're saying. Okay.
Yeah, Vanguard. Yeah. Charles Schwab is good too. They both have their own versions of the.
Right, but again, because I don't want to start off with 25K right off the hop to like dip my toes in, see how platforms work, check out.
And Vanguard
get more
and
information.
Charles Schwab, they don't have an account maintenance fee. They actually pay you. With if you have a cash management account, they actually pay you for holding cash in there.
Okay.
Versus these, if we look at Wealthsimple, they charge you every month.
So you need 100,000 in assets to not be charged a $10 monthly fee.
Yep.
Okay, but this is U.S. accounts.
USD, yeah.
Yeah, so I would be doing the Canadian account, which then I don't think they have any fees, but they have the management fee.
Yeah.
Okay, fair enough.
Versus,
I think it's the first 10,000. It was managed free, I believe.
yeah.
Okay, but anyway, like that's some information that I'm going to have to do versus that Wealthsimple because again, I haven't done too much.
But you have
research
friends
into
that.
it. They recommended it through Wealthsimple, and there was like take a look at that, and I guess that's why I brought it up as well.
Wealthsimple, something because the three OGs, Fidelity, Vanguard, and Charles Schwab, their what do you call it? User interface is not very intuitive. It's not very user friendly.
Okay.
Versus Wealthsimple, it's very user friendly.
Yeah.
So it's a lot easier for younger people like us. Oh, this is how I buy and sell. Versus like when I first started with Fidelity, I didn't need hand holding, but it wasn't built well.
Yeah, the UX design wasn't great. Yeah.
Now Fidelity is like their UI is pretty good, but I still think that the other brokerages, the zero commission ones, the fintech ones, their UI is still better than like the big three, but the big three offer better services.
Correct.
I'd rather have the better services
than a better looking.
better looking. Because I know what I'm buying.
Yeah.
I'm not trying to look flashy, right?
Yeah, fair enough.
Yeah. And then you want to buy so here is an S&P composite of the Toronto stock market, Toronto Stock Exchange. Over the last 10 years, if you were, let's say you want to invest in the Canadian stock market instead, last 10 years, its annual return is 5.07%.
Okay.
Okay. If you were to invest, this is just holding Canadian stocks.
Yeah.
Okay. If you were to invest that same 10-year period in the S&P 500, 10.49%.
So the S&P 500 is U.S. companies, but
That's US.
I'm assuming I can use Vanguard to then invest in the S&P.
Yep. You can use the Vanguard to
500 in CAD.
Yes.
Right.
They have
So
their own.
then I would just invest in the S&P
Yeah.
500 versus the TSX. Right. Okay.
Yeah.
Fair enough.
You could do that. Yeah. So those are the returns. And let's see now how we're going to get there. How we're going to get to your $4.3 million.
Yeah.
Okay. So what are you planning to spend every month with $4.3 million? Like what is the expense?
Well, so I did it
imagine
to
you
like an
have a payout.
online calculator, right?
Yeah.
So like it calculated that would be the at 65 for me. I would need 4 point something $million. I can't remember exactly.
Yeah, but what would be your monthly expense? Like what do you imagine you would be spending every month?
Well, I wouldn't know. I estimated about 10,000 a month.
On what?
I don't know.
Yeah.
Whatever. To live a comfortable life, I guess. Like,
I can think of living a comfortable life on a lot less.
A lot less.
than
Yeah.
that.
I mean, see, that's the thing. That I'm doing it not personally. So it's like me and my wife
And kids.
and kids.
And grandkids.
Sure.
At 65. Yeah.
Right. Yeah. Of course. Yeah. Hopefully. So that was that. So my finances are not done individually. They're done on a household basis. So it'd be like me and my wife would be on the same.
But what is the biggest expense you foresee? Because I assume that your house would be fully paid off. And for most people, that is their biggest expense, being between around 20 to 50% of their monthly expense is housing.
At 65, I would hope my mortgage is paid off.
Yeah. So what do you need 10,000 for? That's what
I mean, I don't know. To live a comfortable life. What if I have a yacht? You never know.
Oh, so you want to own a yacht? Okay. Yeah. You're gonna need a
Well,
lot.
again, I think the 10,000 is a little bit excessive. Probably closer to like 6 to 7.
Yeah.
But if we're saying today's money, right?
Well, I'm not trying to destroy your 10,000 dream.
Yeah, fair.
I'm just trying to find out what it's for so I can help you realize how to get there.
Well, I mean, again, like I think 10,000 was like an overestimation, just to see, okay, like at the best case scenario.
Right.
you know what I
I'll
mean?
give you an example.
Yeah.
For me, my best case scenario is traveling around the world every
Sure.
single day of my life,
Okay.
and I can do that on $3,000 a month.
Okay, but then
But that-
times
but-
that by
but-
2.
But that's
For me, anyway.
That's for me.
Yeah, right.
But I have a specific thing I'm spending it on travel.
Okay.
You right now, you told me it's for family, but family for what? What are you guys doing? So if I was,
I mean, it's to do anything we want. So let's say, for example, if we do want to go travel, it wouldn't like hit the purse too hard
Yeah.
to then go travel. So
Yeah.
if we want to go on vacation, if we want to, come back here, live here for a while, neither one of us would need to work here or live in Castle, like owning 2 properties.
okay. Well,
Other things like that.
what do you plan on? How do you plan on getting that monthly income?
Right, through the investment. I was
Through the
assuming.
investments,
Right.
yeah,
So
yeah.
like at 60, I don't want to, at 65, if I don't want to be forced to work is the situation.
Okay.
Right.
So I saw on your paper you had 2 options: stocks and real estate.
Right.
So for real estate, you would be counting on a monthly cash flow from rental properties.
Exactly, yeah.
And then stocks, you would be either collecting from dividends or selling off portions of your portfolio.
Well, because I'm assuming at 65, you would then start selling off portions of the portfolio to then get that threshold.
So you
correct?
you could look this up. It's called the Trinity Study.
Okay.
The Trinity Study says if you invest in an index fund like the S&P 500 and it continues growing the way it has since the last 90 years, and you withdraw only 4 to 5% of your total nest egg every year, even if it goes down in a down market, you should be able to live for the next 30 plus years without it depleting.
Yeah.
And if you withdraw even less than that,
4% per year.
yeah. So if you withdraw even
What would
less
that
than that,
look like in
With-
actual money account?
so 4.3 Canadians, let's just say 4 for easy math,
Yeah.
$160,000 a year
Okay.
Canadian.
So at that point,
You would be able to withdraw that
per year.
per year without reducing your nest egg of your nest egg will grow even
And that was 4%. So times that, what would the total need to be?
your total was 4 million.
To withdraw 4% a
Yeah.
year.
4 million.
Yeah. Times 4%. Yeah, okay. All right.
Quick math.
Yeah, well done.
Yeah, but also assuming that it's capital gains, you need to pay 15% on that.
Right, so it
So
would be 15%.
of that would be 24,000.
Yeah, so 130,000 more or less.
Yeah,
But which is perfectly doable. It's a
yeah. That
double
is
household. Yeah,
that is
with
more.
mortgage and everything else paid off.
Yeah, and that's more than your 10,000.
Yeah.
Your current goal.
Yeah.
Now, you could totally do that, but we need to use a compound interest calculator.
Right.
So let's go to compound interest calculator. Okay. It would be around 2 million,
Right.
but you only put in 396. This is assuming at 8%. Okay.
So sorry.
This is assuming it's at 8% interest rate.
Yeah. So my
Instead-
initial balance plus the 1,000 a month,
Yeah.
and then this does 8% yearly interest rate.
2 million.
Okay.
Almost 2.1 million
Okay.
by the time you're 65,
Yeah.
but you're only putting 1,000 in.
Well, initially, right? So
Initially.
my current initial would be closer to 50,000.
Oh, you would probably put 50,000.
Yeah, well, the 10,000 is just to dip my toes into it to see, like it was like the $100.
Okay, 50,000, and then this is assuming that it's only 1,000 for the you increase your income.
Sure.
Whatever,
Yeah.
and this also at a lower percentage rate.
Mm.
Yeah. So if,
But I don't think it's going to change about that much between 10 to 50. Really, initial investment. Yeah, see, it's not that bad. It's not that much.
2 million to 2.6 million.
Yeah, but I mean, it didn't get me to 4, did it? No.
It didn't get you to 4,
Yeah.
but it got you an extra 500,000.
Yeah, which is what it is.
You say it's
fair
nothing.
enough.
It's
Okay, yeah,
it's
fair
nothing.
enough.
Yeah. He says 500,000 is nothing. Hopefully, I have his money someday. Yeah. Yeah. So let's try to adjust some numbers.
Yeah.
So let's say 50,000, and then you do 2,000 a month?
Well, I think 2,000 is very high though on a monthly basis.
Well, considering how much you saved the last 4 years, I think.
But you have to take into account in the next year we'll be having a kid, and then we'll also be paying a mortgage and things like that. Yeah,
But this is assuming just you are saving.
I think in the next 3 or 4 years I'll be a single household income.
Really?
Yeah, because we're going to have a child.
But let's say you do the 50,000 and you find a way to scrape 2,000.
2,000 together. Yeah, I would get to the goal.
You would get to the goal.
Yeah.
But you have to also assume that your income is going to grow because you're also getting your master's degree, assuming that your job will increase your income because of that, and also years of experience.
Yeah.
Yeah.
Okay, fair enough.
It's got to be doable, right?
Yeah. No, I agree. I think so. The goal here would be to try and get 2,000 every month, 2,000 USD every month to be invested.
So about 14,000 kwai.
Yeah.
14,000 kwai
RMB,
is RMB, yeah.
Yeah. Okay. Yeah. Okay.
That's the goal. Yeah. That's just if you do the S&P.
The S&P 500.
Yeah. You could do other stuff like if you end up doing single stocks, but I don't really recommend it if you don't like that. I like it because I feel like I'm an owner of a company.
Okay.
I'm now a boss. Yeah. So that's that. And before we go, I would like to ask you a few questions.
Yeah, you got it.
Did I help you get there?
Yeah, I think so. I think my biggest worries about where to start off, what to use specifically, and you gave me another tool through Vanguard, or even looking to Charles Schwab. So that's something that I will be going into. And going through things like S&P 500. Now, obviously, I don't think you could be invest in this particular stock or that particular stock, legal reasons or whatnot.
Yeah.
But that's something that I need to do research on, and something personally that I would like to start doing research on as well. The biggest thing was to figure out where to begin, and I think you gave me a good stepping stone for that. So
also, biggest thing is fees.
Yeah, that breakdown, the load fee versus the expense management versus the turnover stuff.
They're not going to tell you that. Oh, they'll tell you that, but you're not going to understand it.
Correct.
It's going to sound like gibberish.
Yeah. So you basically what you want is no load fees, your expense management to be as low as possible. And then the turnover rate to also be as low as possible.
Yeah.
Okay, which you recommend the 3% from Vanguard versus other brokerage firms and things like that.
Well, Charles Schwab also has that.
Okay.
And Fidelity, yeah.
Fidelity also has 3%.
Yeah, but Fidelity is only for U.S.
Oh, fair enough. Okay.
Unless you want to change your citizenship.
Well, that would require a lot of paperwork that I do not want to do.
Okay, so what is your biggest financial win?
Oh man, I don't think I have any big financial win. My biggest financial win was getting my girlfriend, which helped me, I think with her support and guidance and honestly, yelling at me about don't spend money was my biggest financial goal. So that's the biggest thing is don't spend too much money.
Very cool. That is a very good financial win. A lot of people think that is a financial loss. I even had a guess accidentally say his biggest financial loss was his wife.
Oh, really? Oh, no. She keeps me in line. I think for her, it would be the financial loss. But for me, it's definitely the win.
Okay. So now we know your win is your wife. What is your biggest financial loss?
Student loans.
Student loans?
Student loans, yeah. I think, I've told you personally this story, and I guess I wanted to share for the camera as well, but my biggest loss, actually, financially wise, was not understanding how student loans worked while getting student loans. Now, going through college was very important for me and my family and things like that. And I would do it again, but potentially in a more return on investment major rather than political science and economy and things like that. So but also what happened was that after I got the student loans, after I graduated, after the 4 years happened, I was starting to look for a job, and I went into got called for jury duty almost right away, and couldn't get out of it. So they didn't pay me very much, and I wasn't able to pay on the student loans. And then I moved to Japan. And then I kind of put the student loans, whatever, I'll just pay. And then they deferred, they got pushed and paid, and then they got repossessed by the government. taken off of my bank account. That hurt my credit quite a lot. That hurt like my standing with it, and that increased the interest rate on the student loans. We're going from the bank, which was very low, like 2.2% or something with the bank, versus the government now is like 4.5% to 5% interest rate on it. And
Well, at least it's deferred now.
it was deferred for a little while, which was really nice. Thank you, COVID. But it just hurt my credit so bad that I wasn't able to open credit cards and things like that. But thankfully, I wasn't living in Canada at the time, so I didn't really need to take advantage of any of that, or even get car loans and things like that, right? So it worked out in the end, but I think that was my biggest loss, was like just not knowing how student loans worked, not paying them, and then now,
Being able to pay it all lump sum.
Yeah, which is nice, which is very nice. So my full savings for the past, about half of it for past 4 years goes student loans. Get this done with.
Isn't that crazy? 1 year you have to ask to use the restroom, and the next year you can borrow tens of thousands of dollars.
Yeah, right. Exactly. Yeah.
Now, if you were to talk to your 20-year-old self, 20-year-old Ollie in the camera, what would you tell him?
So, 20 years old, I was just starting university, and I was starting university in business comp sci field, right? The reason why I left the business, like business administration field, is because I didn't really care about all the investment side of it, and like managing accounts. And at that point in my life, I'd already like started a business before already, so I felt like most of the stuff that they were teaching me was very rudimentary, and I had learned this already. It was kind of useless. I would say stick with that because here's the thing, right? Comp sci pays a lot of money. Business degrees with comp sci, you start making bank very early. Not only that, but it gets you more familiarized with the investment side of it. And we're on an investment show and everything. Like year 3, year 4 of university, a lot of my friends from year 1 that degree were playing around with the stock market already, using what's the big one called? The program.
Computer science?
No, the stock market program.
I don't know.
Bloomberg.
Oh, Bloomberg.
Yeah, so they were using the Bloomberg machines already, getting very familiarized with them and stuff. And I was like oh, this is really cool. And they're like, oh, you can't even come into the lab. Sorry, dude. So I would say stick with your original degree choices. Don't switch to poli-sci because you like the course material. Yeah. So that's it.
That's very good. Thank you for coming on the show, Ali.
Yeah, you got it.
Hopefully I answered a lot of your questions.
You did.
Big thanks for all of you making it all the way to the end. And now we're going through our financial review of Ollie's financial situation. He has a good nest egg ready to invest, and he wanted to learn how to start investing. I showed him various investments and broke down their fees and gave him different brokerage accounts. That way he can start investing for himself. He wants to have a nest egg of $4.3 million, and I think that is very possible for him because of his current income and his savings rate. He has to invest around $2,000 a month every month till he's 65, but when he's 65, he'll have $4.3 million. Big thanks to Ollie for coming on today's episode of Hot Tip Investments. If you have any questions, please leave them in the comments below, and I'll see you next time.